oil prices right now, they're at the centre of the political and economic outcomes for most Western nations, including Australia. The OPEC Plus decision last week to cut production of oil by a further 1 million barrels a day pushed the oil price above $80 US a barrel, where it stays as we speak right now. But the one country with most at stake, and which could also well determine a hard or soft economic landing, is Russia, balancing its own need for cash amid tight Western sanctions. Vivek Dhar is a commodities analyst with the Commonwealth Bank and joins me now. Vivek, always good to chat to you. Russia is a country that many people considered were hurt by the sanctions, but it's still exporting an awful lot of oil right now.
Yeah, look, in terms of what we've seen so far, this is exactly almost how the G7 sanctions were meant to work, that Russian supply is still up and running, but Russian oil revenues are down. And so that has been the main focus so far, has been the sanctions from that perspective, the Western sanctions, that is, has been effective. But what I think hasn't been put into the calculations is that we have seen OPEC Plus in coordination with OPEC, reduce output. And that means that global supply disruption risks are now higher, given that we're seeing coordinated action. And this is something that I think could be a factor looking forward, is that you could see oil prices spike higher if we continue to see OPEC Plus defend pricing.
Okay, so then go back to Russia, because quite clearly in terms of Russia, there's the G7 and Australia, the UK, whatever, that they have also put this price cap on Russian oil being exported. So they can export, but right now, Russia doesn't want to export at that price because they can get higher prices by selling it to Turkey or India or China. And that's important for them as their revenues in other areas have dried up.
That's right. When it comes to circumventing some of the rules that have been applied from the G7 sanctions, it certainly seems that China, India are happy to be buyers. But in terms of what we've seen so far, it is going to be challenging for them to get to oil revenue levels that they saw last year, because those caps are so effective in China and India arguing for lower pricing. So yes, there is demand for Russian oil, but those caps are certainly showing effectiveness because they're a big price point that China and India can argue to get lower oil prices.
Okay, so then, as I indicated in my introduction, this has a big bearing on the outcome for inflation, for interest rates, and even the economic outcome in most of the developed nations, because they don't want to see oil prices going above $100 a barrel, because that's only going to fuel the inflation that they were trying to crush with higher interest rates.
That's right. That how you play the oil market this year is going to be very deterministic with inflation. And in terms of how Russia's oil exports track is going to be very closely watched. So far, there seems to be enough. But if OPEC Plus and Russia continue to signal supply cuts, we could see oil breach $100 a barrel this year. So far, our forecast is that we'll get to $90 a barrel by the end of this year. But so much is up in the air when we look at what is exactly happening in terms of Russia's supply.
Okay, so then I noted right now Russia is producing around 7.5 million barrels of oil per day and exporting that. As compared with, say, 2021, it's about the same. Last year, 7.7 million barrels of oil per day. So production is down slightly, but really not fallen off a cliff like many people might have anticipated it would with those G7 sanctions.
That's right. That I would say ever since the Ukraine war, the market has always looked to see the level of supply disruptions. And in every single time we've assessed the market, Russia's oil exports have remained very, very resilient. And that continues to be the case. And I think that is a safer assumption now, just given the fact that we've seen China and India keep being resilient buyers despite the sanctions. So I think that has certainly been a big surprise ever since the Ukraine war, is just how resilient those exports have been.
Okay, so just explain one thing. If OPEC Plus and Russia cut production to push up prices to make certain they have control, does the West have other alternative sources of oil that they can bring into the market to try and keep a lid on this price growth and therefore the inflation?
So before COVID-19, I would have said US oil supply would be the main way that the West would have responded in respect to higher prices. But what we've seen pre-COVID and post-COVID has been a very different US shale sector. Previously, they were looking at maximizing production. And we saw that when oil was $60 a barrel, that's when US oil production was at its previous peak. But now we're seeing a bigger focus on returning capital to shareholders. And that has meant that the US shale sector, in terms of their production growth, has been far more disciplined. And for that reason, there's much more control over global supply from OPEC+, which means the West has limited options to really mitigate what is happening with Russia and other OPEC+ nations.
I'll tell you what, it's going to be fascinating just to watch this play out. And we'll keep in touch with you, Vivek, just to get across this, because it's important for economies, for inflation, for interest rates, and obviously for fuel prices as well. Vivek Dhar, commodities analyst with the Commonwealth Bank, many thanks for your time today.
Thank you.